Good morning, traders. Oh, we just missed it by 1 minute. We're close. Good morning, guys. It's Wednesday webinar. It's October 9th, 1 minute after 8:45. Hope you guys are doing well. Let me just check on the watch page here, make sure we're good. I'm sure we are. Let me know how the sound is. Sounds good. Okay, perfect. So good morning. Hey, everybody. A lot of familiar names there. It's been insane. Oh my God, it's been a busy market. It's been a busy travel schedule. Check out these new views I have in the virtual set. Isn't this fun? That's actually downtown Saratoga behind us. Joe, the intern, before he left, sent the drone up and got some good footage. So look, this is a market, guys, where if you're newer in this market, if you're newer to trading, you might say, how challenging this market is. When you listen to all the constant news flow that's hitting the market with fundamentals, with politics, with earnings season coming up, with the Fed cutting rates again here on the 30th of October. There's so much being thrown at the markets, and a lot of the attention obviously is going into the White House and towards the White House and what's happening there. And you think the market should be going gangbusters, and it's just not. Market's, in fact, in one of the tightest ranges that we've seen in a good period. And it's a market that's gone nowhere here. I'll bring up the charts in just a sec. It's gone nowhere over the last, say, since May, right? So the last 5 months. But when you step back and look at the charts, we've been unchanged since January of 2018. So this has been a very range-bound, challenging markets. And in my short career trading, which has only been 19 years now since I've been out of college, it's the experience that I think that a lot of traders would go through. You got to go through this several times before you finally realize and recognize what's going on. And that's when the market's so incredibly frustrating, whether you're from a trading point of view or from an investment point of view. Excuse me. When it just you throw your hands in the air and you say, I can't make heads or tails of this market at all. Forget it. I'm going to just leave it alone, walk away, frustrated. Maybe you're trying to buy the breakouts. They got stopped out. Sell the breakdowns. You get stopped out. And then you just throw your hands in the air and say, I can't do it. Forget it. That's exactly the time when the market goes. And I mean, that's why we love Elliottwave so much, is because it will give you context as to where we are in that consolidation to tell you how long it might last. Is it definitely going to ring a bell and say, correction over, time to load the boat and make a bunch of money? Absolutely not. But it gives you context and it gives you an edge to say when this consolidation's over. So I'm personally fine with it. Again, I've only been doing this for 2 decades. I've seen this movie so many times. I'm like, you know what? It's fine. I'm just going to kind of be quiet. And I've been doing much on the membership. I've been doing much in trading. We continue to be long in our portfolio. And not putting a lot of leverage positions to work in the options market because it's not a time where I think you want to be doing it yet, because we don't have enough clarity in terms of trying to take a direction in the market. You can, if you're option sellers, premium sellers, data positive traders, you can be doing range-bound stuff. But again, I think it's kind of like tiptoeing through the landmine field. You might make some progress, but eventually you're going to get hit. And I think this market does have a lot of potential to rip significantly higher or lower. We don't know. All right, so that's the opening monologue. Let's say good morning to the team. Aleks and Terry, what's going on, guys? How are you?
Hello, guys.
Good morning.
Good morning, Todd.
Finally
Good
enjoying
morning,
some
people.
beautiful fall weather. We've been waiting on it down here in Southeast Texas. But yeah, you guys up north, you got that cool weather a little bit earlier, but man, it is nice.
That's beautiful. Yeah, it's a good time of year. We got the maybe at the end of the webinar I'll turn around. Those of you who haven't seen leaves changing, it's right outside the windows here. Yeah. We've got, I'm going to take the kids up here soon. We're just on the foothills of the Adirondack Mountains in Saratoga, so it's a hot spot for what they call leaf peeping. A lot of people, a lot of them city folk come up here and visit us rednecks in upstate New York, and go check out the leaves. And it's funny, I'm calling a guy from Texas a redneck. Sorry, we're both rednecks.
I'm just
Aleks, do you know what a redneck
New York
is?
calling himself a redneck. That's funny.
No. What's that? I have no idea.
The
Country boy.
country boy. It shows quickly. You know what? The market must be tough because within the first 4 minutes, we're completely off topic. But that's all right. That's right.
I saw the futures this morning up 61.8% of yesterday's decline.
Oh, that's funny.
How about that?
That's good. How about them apples?
Yeah.
Oh, and speaking of, we're going to completely get off topic. You guys have you ever seen any of my vlogs? There's a buddy of mine, Jim Pavaldi, who's in the office. His desk is right over there, and he's into gongs. He does these gong therapy sessions, and I'm going to help him do a video. He actually does. He gets like tons of people to come out and participate in these gong therapy sessions. He beats the gongs, and I'm sure I'm not using the right terminology, based on the Fibonacci sequence, which he says a lot of the amateurs out there will just bang away and just shake up the room and it'll shake your insides. But he does it based on the Fib sequence, and I'm going to try to record a video with him, and he's going to show us what he does. So you're into Fib. Yeah, it's actually incredibly, right off the deep end, but, there's got to be some Fibonacci aficionados in this room. So you might find it interesting. We're going to encourage them to do that. So, all right, let's pull it right back on. We have no guest today. Specifically, a couple things I wanted to do. I wanted to bring on Aleks and Terry. We didn't do crypto last week, and some people were mad about that. We'll get Aleks in. I want to just show you quickly what we're doing in the indexes and also in the macro markets. And I want to also then take you through a few slides and show you what I brought to the Nigerian conference in Vegas, I don't know, 3-4 days ago. So I did a lot of work on that presentation, and I thought I'd share some of those slides with you guys, okay? So I'm going to get that on track here a little bit. I'm not set up for this slide to bring you guys in. Aleks and Terry, you know what? I'll keep you in on this one right here on the indexes, and then on the presentation slide, unfortunately, I'll have to
Go for it.
just only because I'm not set up. All right, so here's the deal, guys. And how's everyone doing? Richard, short the S&P? No. And I'll bottom line it. I think at the end of the show here, hopefully we'll get you done by 9:30. I think we go higher. I'm going to bottom line it for you. Okay, cut right to the point. So a couple things. A lot of people say, well, Todd, head and shoulders, left shoulder, head, right shoulder, neckline, tried to break through, rallied back. Okay, I can see it. Problem is, there's no head and shoulders in the Nasdaq, and I actually would propose to you that the rut, despite its underperformance, the small cap Russell, has actually shown pretty constructive corrective price action in the downside that eventually leads to a move on the upside. So I don't see small caps in as bad of a light as everyone else does. If you want to talk about this head and shoulders, yes, but always have context, always have an idea what's happening at the larger degree of trend. I would say there's a more powerful inverse head and shoulders happening. And this head and shoulders that everyone is telling me is happening is merely just the right shoulder of an inverse. Left shoulder, head, right shoulder. If we somehow can get any kind of positive news, the S&P is off 120 points from the all-time highs. Like it's 4, 5, 6% or whatever it may be. It's nothing. What is this? Actually, I'm curious myself. Right now, at yesterday's close, we were down 3.1% from the all-time high. And everyone's screaming that there's an imminent recession. Like, are you serious? I've never met so many accomplished PhD economists who can see clearly down the line that recession is coming. I mean, yes, we've got a data slowdown. Perhaps the U.S. is catching down to the rest of the world after astronomical growth, but have we moved into contraction? The markets are telling you no. So I think you need to not lose sight of the forest for the trees, and the other way around. Lose sight.
Yeah,
Is that right?
Yeah. That's
Someday
right.
I'm going to get that expression correct. Lose sight of the forest for the trees, because the forest is telling you there's a massive inverse head and shoulders happening here, and we should continue higher. As we pull in some more wave counts, there are still several possibilities here. I still have been tracking this count. We've been tracking it since early, actually somewhere back in here, like November 2018 in here. We started to possibly foretell that this was a triangle. I'd be 3 waves down in A, and I could show you the chart saying, hey, I think this is just going to be a 3-wave move. We're looking for a 3-wave move up here in B, and that color needs to change. That should be a green color. I don't know why it's showing blue. That's weird. Doesn't matter. This is, I think, a big triangle in B, and then we're going to make one more push up in C of B. Now that does allow a pretty significant decline. Okay, is it you know, is it saber rattling? Is it saber rattling? Is it earth shaking? I mean, you know, you're going to get a pretty decent decline if this count works. Okay, but for now, I will show you the alternate count. But let's work on this B wave triangle a little bit and kind of show you the source of your frustration, if in fact you're frustrated in this market, which that's what triangles are designed to do. By very definition, that's what sideways triangles in the Elliottwave world are designed to do. So it's a 5-wave move, right? We go down in A, up in B, down in C, up in D, and we just went down into E. We did a very clear member webinar 2 weeks ago, right, Terry? With our members, we're like, here's your should hold zone, and here's your must hold zone, right here. And so far, we got down on this candle to 2853, which is just below our should hold zone, and didn't get anywhere near invalidating our must hold zone.
Only on the wick of the candle. So it was a quick, rapid descent and rapid recovery. So
very good point. And then
into the should hold zone. So.
Yeah, exactly right. Yeah, so we absolutely right. The wick of the candle, this was on the 2nd of October, got down into some scary zone, but then we closed right back, had the next day of follow through, a little bit of an inside body day. We just saw a sharp decline, and off of the daily, let's get down into the 60-minute, and here's that price action. So what's interesting is now we rally back up, as Terry just said. We just did another sharp decline back down, and here we go again with the should hold, must hold. All right, so guys, this is your should hold zone. If you're looking at the retracement from the rally we just saw up over the last 5 days, you really should hold 2895 to 2877. That's your should hold. You start getting below 2877, and now you're in your must hold zone. So yesterday, we sold down right into the 61% retracement, which you can clearly see is a big old 3-wave move. There's nothing 5 about it, which you guys know if the 3s are pointed down and the 5s are pointed up, the trend is up, right? And you can easily see a nice little 5-wave move off the lows here on this recovery, okay? So you have 5 up, 3 down. Set everything you think you know on the politics and the fundamentals aside. Trust in what you see, and right now support is still valid while we're only 3 or 4% off the all-time high in the market. I just want everyone to step back. Also step back, okay, and again, if we start getting any kind of follow through here in the B wave, through 29.25 above there, close that gap, I think we're going. And I think the market's starting to sniff out some positive news, because there's been a lot of bad news thrown at this market, and all it can do is that. Everybody good? All right, so that's that. Now, of course, guys, I'm always looking at multiple scenarios. I am smart enough to know I'm not smart enough to consistently foretell the future. I'm always looking at multiple scenarios. This is another wave count interpretation that does foretell something much sharper. If we do get a continued push through 2820, down into 2730, there is a significant decline, okay? There's a significant decline coming. I have yet another wave count on the green, right, Alex? Yep. There's another significant shallow correction happening, which has just been sideways. Okay, I don't know what's going to happen. 2 of the 3 wave counts that I have say we go to at least 3,200. It's good enough for me, right? So that's why we've maintained 80% of our equity positions. Actually, we're down to 75. We've got a lot of dry powder in the option portfolio. And if we can get some clarity that either of my 2 counts, our 2 counts, sorry guys, or this holds, then we will look to put more capital to work. Guys, any thoughts on that? Alex, Terry?
The other thing about this this alternate count that you might want to mention is the fact that
which one? This one or the
blue count? Your blue count.
Okay.
You struggle inside there to find 5 waves.
Good
down.
point. Good point.
And so in impulsive markets, whichever direction the 5 waves are pointing, usually is the direction of the trend. Isn't that right?
Great point. And what Terry is saying is, okay, so let's go back to the daily. And if this is in fact accurate and the D wave is over and we're about to start dropping, let's look inside of these efforts on the downside, and they should unfold as 5 wave moves. So off of the daily, let's look at the decline from July 30th to August 2nd and September 13th down to October 7th. And what you'll see is they really don't count well as 5s. And I went through this exercise with the members. The best I could come up with here was sort of a diagonal in 1, up in 2. This like, I despise when somebody labels a wave 3 like this. It just shows you they don't know what they're doing. And I was just doing it just to show the unlikelihood that it is in fact a 5 wave move, because this is a 3. Your wave 3 should break down into 5 clean waves. This is a 3. Okay? And if you say, all right, Todd, we'll just do this. All right, fine. You go 1, 2, 3, 4, 5. All right, but that's not a 5 wave move in wave 1 either. Right? That's a little 3 wave move. It's better, but it's pretty ugly. Okay? And further, we have truncation in wave 5 versus 3. So wave 5 did not make a new low below 3. Not wrong, but ugly. So fine, let's go to the wave 3. Same thing. If you're starting to break down in orange 3, where's the 5? I have 1, 2, 3 up. You could scrape a 5 wave move out of that, but we have a massive overlap coming back. So unless we're doing orange 1, 2, blue 1, 2, green 1, 2, guys, that means we're going to be at like 2,500. If you were to lay these wave counts out in a textbook wave count manner, like how sharp the decline would be if this count is in fact accurate. And I'm sure I'm going right over Alex. Alex, can you feel me dropping wave labels over your head?
Yeah.
The sky is falling.
The sky's falling on your head. The point that I'm making, Alex, you can hop in here, is this is the path it should follow. So in the next 20 days, the S&P is going to be 300 points lower. Maybe. I don't think so, though. I don't think so. There's much bad news. I mean, unless we get some kind of solid evidence of impeachment, trade deal completely falls apart, all those things could happen. Anyway, Alex, I'll let you jump in here 1 second. Then the last thing I propose to you guys is maybe the future's not written yet. If you look back to Slumdog Millionaires, the future written. Maybe we don't know what's going to happen. Maybe there isn't a predetermined path as to what's going to happen in the future. Maybe the huge hedge funds that are going to sell don't know they're going to even sell yet, or whatever sovereign funds or whoever is going to have enough size to push this market down. Maybe you just can't know what the future is going to hold yet, but that's okay, because we're going through the process of examining the now and controlling the now the best that we can, such that we're not going to be surprised in either situation, and we can quickly move our money in accordance to the path that plays out. Alex, go ahead.
Yeah, I find out what the leaf peeping is.
You did.
Yeah. So because I didn't know what the peeping word means. So
okay.
I was thinking, like peep. So.
On that note,
Okay. Yeah. Okay. So I was thinking there is a bunch of people going out and actually peep on the leaves. So I could not, like. Okay, let's go to market.
Bless you, Alex.
Yeah.
How many from Serbia?
Yeah, I will come because you two explained very well technical side. I will go from a fundamental side a bit.
Sure.
And I will throw in a few things. Firstly, I have been talked with Terry almost 2 months ago, okay, or 2 weeks, sorry, and I said, according to the things they're standing now, my judgment is they're gonna make a trade deal now, and they're going to leave the major issues for the following year, okay?
Okay.
And now that is on the table.
All right.
So because both of them, if you see technically, they need the deal, some of the deal to be reached. Trump doesn't want the whole deal. He wants the whole package.
Yep.
But the economy is shaking. Chinese is shaked very well. So they're going to, in my opinion, make a half of deal and leave the major issues for the next year.
I think that's a good point.
That's my opinion.
And I think tell me, and I'm speaking above my pay grade here, but isn't there something that if there's business left unfinished or there's some kind of negotiation left unfinished during an election, isn't re-election more likely if there's an issue on the table because the public knows that the person perhaps will be set back a long period of time as a new president comes in? I don't know. I could be completely talking out of my ear on that one, but I'm pretty sure I've heard that before. Let me know if you guys have had any experience on that.
Yeah. A second point is the Fed. Powell clearly stated yesterday that he will stay accommodative. He completely changed the record.
Yeah.
So from a few months cutting balance sheet thing, he's now completely into redo the balance sheet, expand the QE. So
well, he didn't come out and say it's QE. I mean, we've seen balance sheet. Yeah. We've seen like a 5% expansion in the balance sheet, right? Or
it was due to a dollar funding shortage market, repo market, which we all know what happened.
Right.
But in the yesterday speak, he also reiterated that he doesn't see the reasons, and the Fed doesn't see that economy is going to slow down. Okay.
Since when is the Fed good at predicting future economic progress?
No,
but I understand your point.
My point is that you can also build a thesis from the so negative news. You also have some strong positives. So I think when we see the first earnings and when we see some things, I think there is also a potentially very soon lots of positives to this market.
Okay.
So
I agree with you.
You might get very instantly trade deal done in half, and Trump can come out and say, okay, we did the half deal. We're going to leave the rest issues for the next year. They're going to import more soybeans, a food product. We're going to alleviate some of the trade tariffs from some products, and that will be kind of a thing which will push markets higher.
Yeah.
So also you can have earnings which can come out good. Fed can cut interest rates. So there is a lot of positives as well. I don't know why people always look short it. And if you combine this with technical side, you will get a more probability that you're going to go on upside.
I agree. I totally agree. I 100% agreement with you, Alex. Very, very well said.
Like you explained, 5 waves are not visible there. Right. Correction is very clear technically from Elliottwave perspective.
Look, we have earnings. We have earnings coming up. In a week. We'll see what happens. I think the bar is set quite low for this earnings season. With the Fed, as you just said, they're going to cut again. They're probably going to cut again. When's the next one? In November. I mean, we're catching down the rest of the world. So I think there's a lot of reasons, and I've got some other ones that I want to talk to you guys about. So let me hop in, Alex. I'm going to bring you in right at the end to hit us some cryptos and FX, but I want to take you guys through a couple more fundamental and some indicators that I think are showing evidence that we might have some more upside to go. So, guys, I'll be right back with you. Okay.
All right.
So, these are some of the slides that I brought to the Market Rebellion speech in Vegas, which was a lot of fun. It was Kevin O'Leary was there, and Scaramucci was supposed to keynote it, but he canceled. Unfortunately, I think there was something wrong with something going on at home, I think. But I don't know. I'm not spreading any rumors. I don't know. But it was good. It was a good event. There was a lot of people there, probably 400 or 500 people there. It was great. So gave a good speech, I thought. Good response. I just want to show you guys a few of the key slides here. Okay. So we just came off the lowest realized vol in 100 years. Okay. I think some of you have seen this slide before if you've been with me. But APTR is average true range, right? High to low in a given bar, but normalized for percent, okay? And that's how you look at a Dow in terms of 27,000 Dow versus 1,000 Dow to compare realized volatility to realized volatility in much different spaces. Percent changes normalizes everything and allows you to compare apples to apples. So this is a great indicator. This is APTR. This is just available on the Thinkorswim platform. What I'm going to show you is we just came off the lowest range in over 114 years. All right, so first one, let's just go back in history. Here's the APTR indicator, and you can see I have the lows supported with a line down there. So June 1914, we came off of a 4.7% month over month range in the Dow right here, which led to a pretty good sell-off. Next one is 1954. Let me maximize this and get my head out of the way here. Let's do it this way. Okay. March 1954 was 4.59% before we went on a major rip and rally in the roaring 50s. 1965, Beatles have just gotten to America, which, by the way, I just watched that movie with my wife last night, yesterday. You guys watch that? Where a guy wakes up and he's the only one who remembers the Beatles music, and he goes on tour with it. It was a pretty good movie. I enjoyed it. So 1965, we're 4.65% in 1965, and then we went into a pretty good sell-off there in the 60s, leading into the stagflationary 70s, which actually had pretty good range, despite going nowhere in the 70s. We're up around a 10% month-over-month range in the Dow. Then 2007, we got down to 4.77%, which then led to the credit crisis. Okay. And then here we are, just in December 2017, before everything just got shooken up a whole bunch. We're at 4.55%, which is the lowest on record since 1905. So the point of this slide is, okay, we just came off the lowest realized vol in over 100 years, number one. Number two, look at the recoveries that you see following these low vol readings. You see a move all the way up. Look at the scale, 8, 9, 10%. Good move up. Decent move up to about 8%. Great move up to about 10%. Huge move up quickly to 10%. We're only at 6%. We have a lot more realized volatility to go before mean reversion has completely occurred. Okay? So I think that means we're going to continue to see a lot more volatility. And in fact, we're only seeing 6% month over month volatility, realized volatility ranges in the Dow. Historically, coming from such low levels, we should be up at 8, 9, 10%. All right, so this continues. Okay, this continues. And that ties in with our Elliottwave count, which again, I think is possibly continuing through a triangle through 2020. All right, so this is kind of the fluff, kind of my three-step approach. I'm just going to show you guys the highlights here. This isn't like the full presentation, but this is my three-step approach to how I trade the markets. My members know that. All right, so let's just go through. Recession imminent. The point I was making in this slide is like, guys, if everyone is so sure we're standing on the train tracks to a coming recession or stock market crash, just get off the tracks. You know what? You don't get hit by the train you see coming. So last I checked, we are set to cut interest rates on the 30th. We're going to be down to 88%, I think, with the move up today. I looked yesterday, I thought we were like 79%. Whatever, we're going to be pretty close to a cut, to a rate cut. What I find interesting on this slide is the percent chance of a rate cut back on SEP 26 was 49%. Then we saw those series of ISMs, manufacturing and non-manufacturing, as well as continued pressure by the Democrats to go forward with the impeachment inquiry, pushed this up to almost 90%. So that's a pretty big move up in 1 week. Why can we cut rates? Well, I think the most important thing is the Fed has a dual mandate, price stability and maximum employment. Employment's pretty good, and price stability is certainly here. And in fact, it's nowhere near unstable or unstable. We can't get above any kind of 2% PCE, personal consumption expenditure reading, which is the Fed's preferred inflation rate. You can see we just did a nasty double top up there over the last 4 years, beginning to back away. We should be cutting rates, right? And I was of the opinion that, well, what are we doing cutting rates with the market's at all-time high? Well, let's not go on that. I'll take that back. Let's not go down that path right now. So what we're doing from an interest rate point of view, a global interest rate point of view, is we're catching down to the rest of the world. So in 16 through 18, the U.S. was doing fairly well and being reflected by our higher rates, selling of our long-term treasuries to get into stocks, pushing our longer-term rates higher than the rest of the world. These are the counterpart 10-year bonds in the UK, Germany, and Japan. You can see as the U.S. made a new high, UK didn't. Germany didn't. Japan definitely didn't, right? So we are now catching down to the rest of the world, which we're truly in a global economy. You can't have interest rates so much higher in the U.S. compared to the rest of the world. It's just going to choke off any growth that we have. So we're catching down. You guys know bonds up, yields down. You guys should all know that. This is like 30-year bond. You can track the TLT, which is going to move inverse to the interest rate. Okay. I'm going to skip this kind of fluffy part, which is basically if you're at a cocktail party, throw this one out there. What's the traditional correlation between the 30-year bond and the S&P 500? Most people would tell you that it's inverse. I would say to you that we've been trading together for all of my lifetime, since 1979. There's only 2 occurrences where we've seen the correlation between stocks and bonds go negative. That's in the 2000 crash and 2007 crash. What's interesting is we're seeing inversion. We're seeing inverse correlation right now up here, but what's happened is there's no stock market crash. So the only time we've seen stocks and bonds trade opposite in their perceived textbook direction is in stock market sell-offs. We didn't see that. So what happened? What happened to the inverse correlation? It's because the bond market sold off, not the stock market. We tried to end the 40-year uptrend in bonds. The Fed tried to pop the bond bubble. Markets tried to pop the bond bubble, and they said, nope, we just came right back ripping higher. And I think that's going to put this correlation back above zero where stocks and bonds continue to go up. So I think interest rates are going to continue to go down as stocks go up, as they have for 40 years. Okay, so let's look at the yield curve inversion here. Let's look at this one. All right, this is traditional 3-month minus 10-year yield curve. There's been a couple occurrences in the 80s, 2000, 2007, and currently where we're seeing short end rates higher than long-term rates, so-called yield curve inversion, which in theory should sell the stock market off. Grant says, will we see angry Todd today? That's fine. No, I'm good. I'm happy. I don't mean to yell at you guys. All right, but this is interesting. Okay, this one I find is very interesting. So this is the 10-year minus 3-month U.S. Treasury. Right, this is the same chart with just more detail. Take a look at this. There's an occurrence that seems to happen here that only once did not happen in this thing. I don't know how to get this thing out of here. Exit. No, I don't want to do that. How do you move this? Google Slides. Get out of here. I might get angry at this one. Exit full screen. No. Anyways, this is like the 1988-89 where we just saw yield curve inversion dip below the zero, this teal dotted line. Stock market had just recovered from the 87 crash. We sold off for a little bit, but then we went into a ripping 90s to 2000 rally, okay? But in 99 and 2000, we saw this occurrence of a drop into yield curve inversion, a significant bounce, and then a much deeper drop, a second test, a double tap down into 2001 lows with yield curve inversion, which that series of double tests topped out the 2000 tech market rally. Same thing happened in 07 and 08. We had yield curve inversion, gave a pretty good bounce back, and then we went significantly sharper and deeper down to yield curve inversion, which eventually put us into the housing crisis. Okay, what is going on here? Yes, we have yield curve inversion, but is it going to be one of these situations where we do sort of a double test? We go down, hit the inversion, rally back, and then drop down, or is it going to be like 98, 99, which should be the start of the first, right? No, wait, what is that? 88, 89. This is the start of the first Gulf War right here, right? Yep. So we just came through long-term capital, Asian currency crisis. 91 was the start of the first Gulf War right there. So that's fine. So I almost wonder if we're going to have a kind of a situation like this, we might have a little bit of a sell-off, but then we rally back quite sharply and yield curve inversion comes off. If you look at it from a 10s, 2s point of view, we were looking at a 10-year versus 3-month. Look at the interaction of yield curve inversion on the 10s, 2s. In the 80s, as we just discussing, they were assaulting it, like multiple. These are quarterly bars, quarters upon quarters upon quarters of yield curve inversion. Stock market didn't do anything. 95 to 2001, it was 6 years of 10s, 2s inversion, and the stock market went from 700 to 1600. Didn't go anywhere, right? It took 6 years for 10s minus 2s to finally sell off the market. And then in 05 to 08, it took 1 quarter, 2 quarters, 3 quarters, 5 quarters, 6, 7, 8, 9 quarters, 2 years and a quarter before we finally sold off. If you look at where we are now, guys, we've had 1 quarter of this. So don't tell me yield curve inverted, sell it all. Look back, know your history. It takes a couple years for this to happen, if in fact it's going to happen, and it's not unlike 88 and 89, where we just do a little inversion. Market gives it a slight pause, we correct, and then we move higher. Okay. I'm going to skip this fluff. I did lock in my mortgage rates. This is kind of fluffy stuff, kind of a joke that takes a little while. It's based on Michael Burry and trying to price his CDS. The investment banks pricing a CDS swaps. I did lock in my refi and my 30-year. I got 3.37 from TD, which was unbelievable. I told Nicole Petalides that when I did the TD network interview when I was down at the NASDAQ, and she laughed. She liked it, and I threw a little TD plug in there. So I still have this live TLT trade, this broken wing butterfly, as the market's going sideways, so that's fine. All right, let's kind of skip through this. This is Elliottwave stuff, which you guys all know. I wanted to get in the internals. Okay, this is an important part of the market internals. Another reason why I'm bullish. Okay, if you take this is a mistake. This is the NYSE common stock advanced decline line, not the S&P. This is the NYSE, and this is the S&P 500 below. Look at the two divergences that are happening here. Number one, S&P common stock advanced decline line makes a new high from July into September, a clear new high up to 15,900. More advancing stocks than declining stocks, with the S&P does not make a new high. Interesting. Second divergence. Look how far away the advanced decline line is from support, where the S&P went right down to support from the same swing lows. Let's switch over to advanced decline volume. So the volume totaled up in the advancing issues minus volume summed up in the declining issues. You're just going to see the exact same situation. Volume advancing issues made a new high, okay, compared to the old July. So volume advancers minus volume decliners made a new high, where the S&P again did not here from July to September. Also, we're well above trendline support here in this indicator, where the S&P is below it. What this tells me, guys, is breadth overall continues to be very healthy. Volume in the advancing issues minus declining issues is very healthy. There's a few big stocks that are not breaking to new highs, which are not allowing the market to push higher. That's what's happening here. It's FANG, right? There's a lot of financials, big cap financials, big cap energy, Facebook, Amazon, or Facebook, Apple, Netflix, and Google not making new highs. You know, the markets can't make new highs, but there's a lot of stocks rallying beneath them, which is keeping these breadth numbers higher. That's the reason we're seeing the divergence. It's certainly something that's important because obviously with the S&P being a cap-weighted index, you know, without the participation of some of the biggest components, it's going to be a problem. But look, now we have Apple making new highs here. You know, I think there's some signs of life here coming in this market. Same thing. This is NYSE advanced minus decline volume line. Same thing. Same concept. Made a new high. S&P did not. Not testing support. S&P is testing support. Breadth continues to be healthy. Also, a very nice leading indicator chart here. So take a look at this. This is 2019. So this is advanced minus decline issues. May 3rd to June 10th, we made a new high. We broke out above the May high, which foretold in the S&P a break higher, which we didn't take out the May high until like over here in July, where the advanced decline line was well through the high. We move up, advanced decline consolidates, breaks to a new high here in September. Look what the S&P does. We do break a little bit of resistance, but we certainly don't make a new high. We haven't even broken the July high yet in the S&P, where advanced decline is clearly through the high. So will the same kind of relationship continue where you have the S&P starting to break up, maybe get up to these SEP highs as advanced decline finally gets up above 25,000 to new highs? So I think these breadth indicators are very telling as to what's happening. Take a look at this chart. This chart's a trip. This is the 10-day moving average. I'll go full screen on this. This is the 10-day moving average of put to call ratio. Let me go full screen. Okay. The put to call ratio on the CBOE are in the very light candlesticks in the background. I put a 10-day MA on top of these guys. And what you can see is the moving average seems to be respecting some sort of downtrend channel. I don't love to do technicals on moving averages of indicators, but it was just a pretty interesting point. It seems that there is an extreme reading up around 1.2, 1.1 in the put to call ratio. Over here, we hit another extreme in late 18, in that late 18 sell-off, we hit 1.1. Guys, we just hit 1.1 again in the put to call ratio. Here's the deal. We hit 1 point over here back in 2015. We hit 1.2 with a 30% sell-off in the stock market. We hit 1.1 in late 2018 with a 35% drop. We just hit the same put to call ratio with a measly 12% drop in the stock market. So these incredible put to call ratios, these high readings normally correspond with a really sharp sell-off in the market where we haven't seen it. It's just the markets are so they're convincing themselves so much of an imminent recession. They're buying puts, they're buying protection, they're getting out of stocks. Oh my God, world's coming into an end with everything that's being thrown at us in the news media. I look at that and I say, boy, the market's getting well ahead of ourselves. Okay, last chart that I'll show you here is, this is a shorter term, 5-minute chart. The rally that we've seen here over the last couple days has been very much not confirmed by NYSE ticks, which the NYSE tick made a huge higher low, where the S&P made a big lower low down into 2860, and you know where we are now. This was a massive NYSE tick moving average divergence relative to the S&P. So a lot of these internals are not confirming downside. And lastly, just watch this S&P TLT ratio. It's got to stay above 2, and stocks will continue to be stronger than bonds. Okay, let me bring it in. Guys, did I miss anything? Any comments? Definitely. And Alex, are we loaded on? Oh, we're not even loaded on the GoToWebinar, are we?
Yes, we are.
Oh, we are. Okay, let me pull this up quick. Guys, I'm gonna have Alex take us through some cryptos, and are you gonna do Forex as well, Alex?
Yeah, just DXY and Eurodollar.
Okay, cool. So guys, we're gonna do that. Leave a thumbs up if you're heading off to trade the market here. I'm just gonna load my my go-to webinar. I didn't think Alex was going to make it here. 1 second, we'll get Alex going. Your charts are ready to go, sir?
Of course.
Okay. Let's see. Terry, what did you think? Was that a compelling case? Hope I'm right.
So, well, we will see. A friend of mine always tells me, but it's certainly very compelling. Like I pointed out, Investor Business Daily. I mean, they pretty much drive home the point about the put to call ratio. Numbers above 1 indicate market bottoms. Okay, so you can have more than one bottom, but you certainly whenever you get a number above a 1.0. You got to think about that as a localized low. So
yeah,
usually once that happened, then you got a little bit of push.
And that's why I like going with like a short-term moving average, because it's not just the occurrence of a 1.0 or 1.1, 1.2, but it's consistent readings above, which is consistent put buying. So I kind of like smoothing those out with the average. I kind of find it works better.
So it's just indicative of fear in the market, right? So uncertainty.
Yep, absolutely. Absolutely. Alex, it's all you. Take it away, sir.
All right, Alex.
Okay, so this is the very longer term chart of dollar index. I didn't throw any Elliott here. I just wanted to show you the importance of the 96 level there.
Yep.
So if we watch from 1971, basically, the moves of the dollar index, we are clearly for now in the downtrend, and the slope of the rise of this move upside and the slope of the rise of this move upside is even lesser angle. So what we see dollar strengthening after we got off of a dollar standard, we moved sharply down. We went up in a relatively 60 to 70 angle slope. Then we moved down again, and now we are a little bit lower slope ahead. So why I'm watching this 96 level? Because you have a confluence of things here, and if we break this 200 moving average containing trend line, containing a big trend line here, so there is a several key supports. That's why we couldn't broke, because sometimes you need to look this larger time charts to see the confluence of the support and resistance levels, and you might get a clue why it's persistence and why it doesn't go on the upside. Technically, I'm saying. So I'm looking this 96 level very closely, and if we break through this one and 200 moving average, of course, off we go on the downside on dollar index. Otherwise, if we continue on the upside, 618 is here, 786 is here. So there is a possibility that if we continue on the upside, we're going to reach one of these two levels on the upside as well. So I think we are in a critical juncture here, and I'm looking just a break of this line and this line on both sides. According to the euro, I will show you also a longer term chart.
Hang on, can you go back to that chart?
Sure.
Can you see my cursor? Can you see my cursor moving? You almost see an analog here to the current rally.
Exactly.
We go up, we sell off, we rally up, we consolidate. It's almost the same thing. We go up, we sell off. It's almost like we're in kind of this stage right here. What year is this? Is this the 90s? That's probably the 90s heading in the tech bubble right there. It's almost like this pattern here looks very similar to this does coming off the lows.
Exactly, and the slope for now is a lesser degree. So I think that 96 is going to be the key level here.
Yeah.
If we break through 96, I think we're going to go down. I don't know how much that will be to be discussed, but if you look the longer term chart of euro, look at this.
Wow.
This is a very well defined channel, which you see. This is the euro through Deutschmark. So this is from 1978. So as you can see, we are coming very closer to a key point here, which is around 107, 108, which is on this chart, my longer term target. Although I don't think that euro for now will break on the upside. I think that it will be just a temporary break, and then we're going to move one more wave lower. But the both counts I have for now it's pointing possibility that we might have a period of 6 or 8 months that we're going to go higher on euro dollar very soon. I'm just waiting the break of this 96 level.
Okay.
So that's on
Won't that
on
be
cryptos.
amazing? Won't that be amazing when FX finally makes the move?
I will be very glad. I have to tell you. I think I'm gonna have a new birthday there. Okay,
Wait,
so
wait a minute, wait a minute. You're gonna have a what?
I don't know what that means.
What? Let's dig into that just for a little bit. Maybe. Let's go back. All right, let's go back to
okay. Okay, so look at this. This is the S&P over Bitcoin.
Oh, interesting. Oh, pretty good.
I mean,
wow.
Interesting.
Wow.
Yeah. I mean, it's incredible, huh, guys? There is a little bit divergence here, but the lows in S&P actually mark the lows in Bitcoin.
That's pretty. I mean, I don't think you can. I don't think you can refute that.
Even here, when we went, if we go a little bit lower, you will see a kind of a correspondence between this correction here and the S&P. I didn't align it well because I need to go on a higher time frame.
Yeah.
But guys, I mean, they're working in not perfect synchronization, but
No, it's.
I mean, there is, yeah.
That's pretty good.
There is one, huh?
That's good. That's
yeah.
good work. That's good work. Very nice.
Yeah. So
right.
cryptos.
Yep.
I'm looking for this was a very a big correction, which we actually traded, and which is very difficult. And in a sense, what I'm looking here is a small move up in a B wave. I think we're gonna go and trace five more waves down to this support level, and then I will mark this. Wouldn't be great if this will happen exactly as the 618 time ratio, which will be October 25th. And I think we are and we are coming to this. So this is the time relation between the move on the upside and the correction and the time correction, and 618 could be a key ratios which give us 23rd, 24th of October. And I think that is quite possible to unfold. Scrolling down to a smaller time frame.
Wait. What?
Yeah.
What? I think you're at the 50% retracement.
Exactly.
Where's the 60% or 61% retracement? When will we get 61% price and time?
No, this is the C versus A of this correction.
I know.
So we
I think you had a 2v1 green, 1v2, which was I think a 50%.
Yeah, it's already there. I don't know why it's just a second.
Pull it up and then pull it up. Now go down and grab that bottom button. There you go.
Oh, now put the 61 back in. Oh, yeah, what are you doing? Right click on it.
Sorry.
You're right.
No. Right click on your ratio.
I did.
That 61.8. Choose ratios.
I think we're going to be close.
Yeah, sure.
I think we're going to be close to 61% price and time.
Yeah. So we will match this 618 with this with 618. Wouldn't be that cool?
Perfect.
Yeah. So
see, I'm still got to keep my. These guys are such talented Elliotticians, but I'm still the boss. I got to keep my eye on.
So I mean, there is the previous wave 4 consolidation here, which is usual stopping place for the correction ongoing. We have a nice defined channel, a nice, very well proportioned corrective moves here. So if you calculate all of this, the matching point for now will be here. So we are going to start to load a smaller position here. What I want to see a 5-wave move up above this channel, and then we're going to load up for a longer term position in cryptos.
Love it. Love it. So, I mean, you have 72.40 on October 24th. I mean, you could make your whole career on this call right here. If you call this.
Well, if I'm not very well known about this call on these lows, I don't know. This call will make me famous then.
You're already famous. All right. Guys, we got to end it there. Good session, Alex, Terry, great job. Hopefully you guys enjoyed it. Throw a thumbs up on there. As I said, just just keep it tight in here until we start to move out of this consolidation. Don't.
You guys want more of this? Come join our service.
There we go.
Okay, you can get a daily dose of Todd on the
And
premier
Alek
service.
and Terry.
And at Terry and Aleks, we're doing the cryptos and the Forex, and we'll keep you guys informed. If you want more than you're getting out of the weekly thing here, we do this every day of the week. And
Can we get
Todd,
this,
one more thing.
Todd,
One more thing.
off the screen. I hate that. Like, all right, come on. I want to picture. What? Yeah.
Wait, one more thing. One more thing. Okay. Okay. So I'm preparing a big crypto webinar for public.
Oh, when is that?
So it's gonna be. Yeah, I think it's going to be in 2 weeks, but just if somebody's interested to join and look that webinar, we are going to be presenting it as a trading analysis, I think in 2 weeks, and we're going to display the right date on our website soon. So
okay, good.
That is the ongoing thing, yeah.
We don't have a landing page yet?
Yeah, we are in the process, so we're going to put it very soon.
Okay, good. Yeah, be sure to let us know on that one. And then the other thing my my guys are telling me to tell you is, who's going to be in the. So I'm going to be also November 7th to the 9th. We're going to try to get the team out there in Vegas and look who they're using as the top, as the banner up there. Who's that goofball up there? Look, you see the Elliottwave charts in the background?
You didn't get enough of Vegas already? You got to go back again.
I was supposed to go to also Traders for a Cause, and they asked me to go, which would have been my 3rd trip to Vegas in 4 weeks. And I was like, I'm so sorry. I feel terrible not going to that wonderful event. I just came back from the Bulgarian thing. Traders for a Cause, I think, is this weekend. And then this one is 4 weeks later. So, yeah, so come on in. I'm actually one of the keynotes for this, and I'm doing another breakout session, which will be fun. So if you're going to be there, I'm going to try to bring the whole trading analysis team out there. So we'll have some fun. All right, so check that out, guys. All right, we'll leave it there. Leave a thumbs up. Leave a question, comment, insult, whatever you like. Guests that you'd like to see on the show. And we appreciate you guys listening and taking up so much of your time this morning. Aleks and Terry, thanks so much.
All right, see you guys.
All right, guys, appreciate it. Thanks again. Have a great rest of the day and trading week. And as I said, stay calm in here. If you're looking to actively trade, it's very those triangles will tell you everything you need to know. Okay, so be safe in here. Protect that capital. Plan your trade your plan, and come check us out at Trading. See you guys.